should start going back down again in 2015. So only between now and about December to January should we see a big rise in actual CPI inflation rates. We'll still be worried about inflation well into 2015 because it takes a long time for the worry to go down after the turn has already happened. But I think that inflation numbers are going to pick up.
Let's talk along the lines of inflation. What's your take on gold here? I mean, it's got a little spark to it, and we're also seeing, unlike what we've seen in the past, some very good movement in the gold stocks. If you take a look at some of the things like the GDX and the HOI are up quite substantially this year.
They are, and it's a little bit early. There is an important 13.5-month cycle in gold prices that's been going on for the last couple of decades at least, and it's due for its bottom ideally in the month of July. Well, gold started up early, so either that cycle bottom was put in earlier than it was supposed to, or we're seeing a bit of a phenomenon that quite often happens with gold as it's making a last dying gasp right before the real bottom of that cycle, which is to have a late blow-off and then one more sell-off. I think we're going to see one more sell-off in gold prices that will surprise all those guys that rushed in to buy the gold stocks. Then they'll start hating gold again. And when everybody starts really, really hating gold again after that sell-off, then it'll be time to buy for a really strong up phase of gold as it starts this next 13.5-month cycle. But I think that it's a little bit premature, and I think there was a little bit too much eagerness of people to rush back into gold on this little bit of strength. So that tells me that, no, they haven't been slapped down hard enough yet, and gold's still got that mission to do before this real bottom is done.
I guess if I was to sum up, you don't see any signs of a market top or this bull market coming to an end. Maybe we may get a correction here in the short term, but in your opinion, that's going to be a buying opportunity.
That's very well said. We're still in a long-term uptrend. It's gotten to an overdone point within the uptrend, so you don't ever keep going up. You go up 3 steps forward and 2 steps back, and 3 steps forward and 2 steps back. So you've got to have a little bit of a pullback now just to keep the market healthy. A farmer has to let a field lie fallow every once in a while. We have to have winter come along to get all the leaves off the trees so that the new leaves can grow. It's that sort of thing that is normal and natural and healthy, and we're due for one. And then once it's done, we can have a nice rest of the year.
Well, listen, Tom, as we close, if our listeners would like to follow the work that you do, tell them about your website.
Well, our website is called mcoscillator.com. It's a contraction of McClellan oscillator, the indicator that my parents developed back in 1970. There they can see a lot of articles that are free in our Learning Center. You can even sign up for our free weekly Chart in Focus email that will get sent to you, and we won't give you any marketing materials. It's just a free way to find out more about the indicators that we use. We also have a couple of subscription products, a twice-monthly newsletter that's $195 a year. We also have a daily edition that comes out every day to market trades for $600 a year or $160 per quarter. And if you're a new subscriber, you can even sign up for a free 2-week trial of the daily edition with no risk.
You're listening to the Financial Sense News Hour at financialsense.com.
In case you didn't know it, the Financial Sense News Hour is more than just our weekend show. We also have a weekday program featuring key economic experts, which is only available to our premium members. Here's part of one of the interviews from this last week.
Joining us on the program from Hong Kong is Prue Saxena. And Prue, let's talk about one of the prominent theories out there is, and especially in the gloom and doom camp, is a dollar crash. Well, and the dollar is going to be replaced as the global currency. But then I take a look at Europe. You take a look at how long ago was it? A couple of years ago, we were talking about problems with the peripheral countries, the pig countries, the enormous amounts of debt. It's not a complete monetary union. They don't have a treasury. And then you take a look at the problems in Asia, and I'm saying, okay, if the dollar collapses, what replaces it?
I tend to agree with you, Jim. I don't think there's any crash coming in the dollar. We've had QE. The QE is now being reduced in the next maybe a year or 15 months or so. There will be no more QE. And then gradually, interest rates in the U.S. are going to go up. The Fed funds rate is going to be increased in baby steps, in my view, by maybe 25 basis points in one go. And interest rates are going to be normalized in the following years. So under this scenario, I think rather than collapse, the U.S. dollar will probably appreciate in value. If an unprecedented QE and zero interest rates couldn't bring around the crash of the U.S. dollar, then I'd hardly doubt that a normalization of interest rates and the end of QE will bring about the demise of the dollar. I think these fears are misplaced. I think the dollar, if anything, is going to appreciate when interest rates normalize. I may be wrong, but we'll see.
Who would have thought 2014 would turn out the way it has? We've got commodities leading the pack in terms of return. The stock market is up and bond yields have fallen. Joining us on the program is Rob Bernard from PFS Group. Rob, take us around the world as we look at yields here. They've been heading down.
Well, that's right. Last week, we saw the U.S. 10-year Treasury trading about 2.5%. And today, with the advent of the new jobs numbers, which were quite good, the 10-year bounced up in yield or down in price to 264, and the 30-year was at a 348. However, it didn't really seem to bother the rest of the world because United Kingdom's at 274, France 171, Germany weighing in at 1.28, and there's Italy at 284, Spain 267, Portugal, Jim, at a 356 for the 10-year bond. Amazing. Japan is the low boy in the street at 0.55 for a 10-year JGB.
Rob, people have a hard understanding on why U.S. bond yields are as low as they are, and it's because we're a magnet for foreign capital. I mean, if you take a look at Spain's bond yield at 2.67 and ours at 2.64, where would you think your money's safer? Spain's unemployment rate is closer to 25%, ours closer to 6%. So it's no wonder yields are where they are. Let's move on to tax-frees, Rob, because we've seen tax rates go up here in our own state of California. We've seen them go up across the country where you can be up to as high as 44% in a federal tax bracket if you add the Medicare tax and all the other sundry taxes that the government throws into that 39.6% tax rate. That's 44%. You take somebody living here in California where you have 13.3 and they begin to complain like Phil Mickelson did. So what's the tax-free world look like?
Well, the tax-free world has been a very tight world this last quarter, Jim. Smaller than normal issuances. The 5-year across the country averages between 1.5% and 2.5%. The 10 years are averaging between 2.5% and 3%. And the 20 years are averaging between 3.4% and 4%. Of course, depending on what state you are in, that's what you're going to look at as an average across the country. Puerto Rico's been having some indigestion here lately, and it seems as though the government misstepped itself. The governor signed a bill last week that allows some public corporations to restructure their debt outside of bankruptcy. And of course, right then and there, Moody's decided to downgrade the bonds and the Puerto Rico debt out there, especially the electric utility ones and some of the transportation ones, took an instant hit. And it appears that with Moody's downgrading them, it's going to be next to impossible for that island to issue any new debt. So it appears that the governor of Puerto Rico stepped in it big time by signing that bill last week, because all of a sudden now, who the heck would lend Puerto Rico any money based on that potential, not necessarily going to do it, but the potential reorganization of some of the debt of the public corporations.
Rob, this kind of reminds me sometimes how politicians shoot themselves in the foot. They're trying to restructure their debt, roll it over, attract capital into the country, then you do something like this.
Well, yes, and so who's going to move there now when you have electric rates that are 20 cents, 23, 24 cents a kilowatt, when an average is in the United States 10 cents a kilowatt. And here's the other interesting thing. Puerto Rico, unfortunately, is straddled with old oil boilers to conduct their electricity. They have not had enough capital to upgrade to natural gas fired. They haven't figured out how to get natural gas there. So they're in a real quandary. They have to make some very hard decisions. Now, Franklin Templeton, which has a tremendous amount of Puerto Rican debt, as well as Oppenheimer, are, of course, filing papers to challenge that new law. And the public utility of the electric company made all of its debt and principal payments on the 1st of July, so nobody, got stiffed, and there was no reorganization that happened overnight. So with this downgrade, I'm sure the island is going to have to rethink their strategy going forward. One other thing I'd like to bring up, too, is a case study to let our listeners know how we do our business here as far as stocks and bonds are concerned. I'd been working with a couple of partners that had sold their chain of muffler shops in the Midwest, and I set up a diversified income account, which basically has about 70% equities and 30% municipal bonds. And the strategy so far has given us a pretty interesting rates of return. Basically, this 70-30 approach gave us 95% of the S&P 500 gain year to date, but only with 0.71 beta. So basically, we're collecting 95% of the S&P 500 gain year to date with only 29% of the volatility, and a standard deviation of 3.8 versus 7.51 of the S&P 500. And what that has shown is that it is very possible to get a great rate of return on your assets without succumbing to the volatility of the S&P. Now, granted, the S&P has been very docile and very sleepy as it continues to go up, but someday in the future, I'm sure we're going to have a bit of a correction. When you have a 70-30 mix of producing equities as well as tax-exempt bonds, you minimize the volatility of your portfolio a lot. In this case, 29% less volatile than the S&P 500. That's pretty impressive.
You know, two things that also strike me about that is the tax-free bonds. Obviously, no taxes on those, but the other one would be the dividends, depending on your tax bracket, are taxed at 15 and 20% plus the Obama tax. Well, if you're in the 15% bracket, you're probably not in the Obamacare tax. But if you are, even 23.8% is better than, let's say, 39.6%, which is taxable, or the tax rate on interest in wages. Rob, as we close, if our listeners want to contact you, how could they do so, please?
Thanks, Jim. They can contact me at 888-486-3939, and I'd be happy to talk to them about building their own diversified income portfolio.
You're listening to the Financial Sense News Hour at financialsense.com.
Walking in the sunshine, sing a little sunshine song.
In-depth interview from people who monitor all aspects of the markets and the economy during the Financial Sense News Hour weekday show. Here's a brief clip from this week.
Joining me on the program is Joe Dancy. Joe, let's talk about, I love these projections that we see coming from the IA, and they're talking about the amount of demand that's going to be going into the oil market. For example, they're saying that we're going to increase from 91.4 million barrels per day at the beginning of 2014 to 94 million barrels a day in the last 3 months of the year. My question, Joe, is where's the 3 million barrels going to come from?
Yeah, good question, Jim. It's actually the 94 million barrels per day will be another record on a global scale. And year after year, we're increasing demand by about 1 million barrels a day, which is a 1%, a little over 1%. I mean, that's compounded. And this is at $100 a barrel. I mean, this is not discounted oil at $70 or, where you would expect more to be used. This is expensive oil. And actually the IEA even upped their estimate for next year's consumption by another 1.4 million barrels per day. The big question is, the exciting thing is in the United States is that, we are by far the largest country that is showing increases in production. In the last 2 years, and this year we'll show about 1 million barrels per day increase in oil. It's really, some of it's not oil, some of it's condensate or really light oil, but from the Bakken and the Eagle Ford and the Niobrara formations, all have been very positive. The significance of that and how astounding it is, the second largest increase, I think, was the United Arab Emirates, as I recall, with around 200,000 barrels per day increase. Everybody else was either, pretty much even or down. It's real exciting. And then, of course, we have Mexico south of us that has rumored lately to be opening up their market for further exploration.
Over the last 3 months, we've seen an uptick in CPI. Is inflation in our cards in the future? Well, we can take a look at commodity prices. Joining us on the program is Eric Townsend. Eric, let's begin with oil. A little bit of a reprieve this week as we head into the holiday weekend. We've got West Texas down to 103 and Brent under 110.
Yeah, definitely. We're seeing both Brent and West Texas correcting back to the downside. And I would say, Jim, that it's very clear to me that the geopolitical forces are really what's driving this market. One of the reasons I say that is in the U.S. market, we had our inventory report on Wednesday with the inventories drawn down about 3.5 million barrels from the previous week. And as one would expect, that sent the price of WTI crude oil shooting up, just taking off crazy to the upside in reaction to that data coming out. And it was up 75 cents within the matter of minutes. And you know what? That rally lasted about an hour and a half. And we then saw a new low, lower than it had been before the news came out. So something like inventory data that normally is a primary driver in the market is really taking a back seat to geopolitical tension. Now, I don't personally quite understand, Jim, why the market thinks that it's all better in Iraq and Ukraine. It seems to me like the situation there is still kind of out of control. But we do have, certainly from an Iraq standpoint, 4,000 Hellfire missiles were delivered by the United States. The Russians delivered some Sukhoi fighter jets to help the Iraqis out. So Iraq is certainly better armed to put down the insurgency that's going on there, although I don't think that we've seen the end of the fireworks. And that's causing both Brent and WTI crude oil to correct to the downside. Now, as I look at the charts from a technical standpoint, you could read these two ways, Jim. You could say, well, boy, look at the long term. We're really seeing that there was a trading range between 90 and about 102, 103. And maybe we just had this geopolitical upset. It was a very brief tick up above that into the 107 range, but we're headed back down into that trading range, probably headed back towards somewhere between 90 and 103. That's one way to look at the chart. The other way to look at the chart is to say, no, we've actually got a pretty clear uptrend that started back in January, and that version of the interpretation would say that we got maybe another $1 to the downside here before we ought to look for an upside and maybe the next upside target of around 110 if this rally that has begun in January continues. So do we look at the recent events as part of an ongoing rally or is just a one-off upset moment? I tend to think that they're more of an upset moment that we're driven geopolitically, but I don't think the geopolitical upsets are over. So as the summer continues, I wouldn't be surprised if we see another oil price shock. But for now, the trend direction is definitely to the downside. If it goes below about 101, I would say that puts us more into the trading range between 90 and 103. If it bounces back up off of that price, then I think we're headed higher.
Yeah, it's amazing, Eric, because if you take a look at last year where global economic growth was anemic, and we had some pullbacks in terms of production within OPEC. I'm thinking of Libya, Nigeria, Syria, and of course we had all the events of the Arab Spring going back to, let's say, 2011. Now you take a look at what's going on in Iraq, which is supposed to be the next big or the biggest producer outside of Saudi Arabia, and all the great expectations that are coming from the IEA. Just doesn't look like it's going to be realized, but thank goodness U.S. oil production went up by almost 1 million barrels a day last year, because I think we would have been looking at higher oil prices given the pullbacks within OPEC itself.
Well, I think you're right, Jim, and unfortunately, I think we're also going to look at higher oil prices because of this decision that the Obama administration just made to greenlight the export of U.S. crude oil. What we were seeing in the term structure, that's the pricing of the longer-dated contracts for delivery in future months, was essentially the market anticipating a crash in crude oil prices, at least West Texas Intermediate crude oil prices, over the next 6 months. That backwardation that we talked about, I think it was on the 14th of June show, I pointed out a very attractive short on the September through December calendar spread that was all the way at 360. Well, it's all the way down to 231 now as we speak. So that $1.20 of backwardation is now 75 cents of backwardation per month. We're really looking at a changing structure, which says to me that the expectations the market had that the shale oil revolution was going to bring the price of oil down. That got reversed as a result of this crude oil export decision, which I don't think was the right thing for the country.
Let's move on to the next metal that would respond to any kind of crisis. We've seen gold prices this year outperforming the market, big change from the last couple of years. Gold up just slightly, about 0.25% this week, and now we're over 1,300. We even have silver up this week, almost a percentage point. What's going on with the metals? Because at least for now, Eric, we're seeing some movement in the gold stocks because those things have been dead for a couple of years now.
Yeah, they sure have, and we are seeing some movement there. And not a whole lot of new gains this week, but they're holding on to very significant gains from last week. As far as the metal itself is concerned, Jim, this gold chart has been perplexing me. I've been studying it quite a bit for the last week, and, it doesn't seem to correlate with the things it normally correlates with. You might say, okay, the reason that the price of gold is up in the last week or two is because of geopolitical tension. Well, if you look at what oil is doing, it was reacting to geopolitical tension. It was coming off back to the downside. And now we see that gold was really holding on through all that. This morning, Thursday morning, there was a very sudden spike right around the open. Looked like maybe somebody was trying to hammer the price down. That didn't last. It retraced at least half of that loss. And it doesn't seem to line up with anything. Now, there is something that I think could be, in the near term, an upside catalyst for gold, which is, in technical analysis, when the 50-day moving average crosses the 200-day moving average. It's generally considered a very strong signal. When it crosses to the upside, that's called a golden cross. When the 50-day average crosses below the 200-day average, that's called a death cross. Now, I would personally tend to discount the real meaningfulness of this because we just had a golden cross back in April, and it didn't last. We subsequently had a death cross in May. But where I'm headed with this, Jim, is we're setting up in the next couple of trading sessions for another golden cross in the technical chart. Whether or not that means anything, a lot of people think it means something, and that means people will buy it, and it becomes a self-fulfilling prophecy. So I wouldn't be at all surprised if we do get that golden cross in the gold chart sometime next week, for that to give a little bit of tailwind to the price of gold, and I wouldn't be surprised if we're up a bit next week. On the other hand, we've had several banks that have been out on a fundamental level saying they just don't see where this strength in gold is coming from. They think it may be a short-term phenomenon that has to do with this metal hypothecation warehousing scandal that's going on in China, that it will be short-lived, and we will soon be seeing much lower gold prices. So you get arguments on either side. I don't know where it's headed.
Let me comment or get your views on the base metals, because the nice movement in the base metals, and I don't know if that's indicating that either it's inflation or a pickup in economic growth. We have aluminum prices up 2%. You've got copper prices, copper finally starting to move up 1.6%, nickel, tin, and zinc. So what's that telling you?
Well, it's fascinating, Jim, because I would say base metals all moving up at once like that sounds like signs of inflation. But if I look at the grains, we just took out the previous low in corn was back in January, very decisively took that out this Monday. Wheat is also on, looks like a new low, matching its low from January. Soybeans are a little bit stronger, but again, the action has all been to the downside this week, while the metals have shown upside. So why, if it was inflation, would we see such weakness in the agricultural commodities, such strength in the base metals? One potential explanation is this situation in China. And to summarize that, the warehousing of metals, not just precious metals, but copper and zinc and aluminum and other metals, is a very complex system that requires collateral being posted, and there's loans that are taken against it, and so on and so forth. They figured out that some of the metal that's supposed to be in those warehouses in China is not really there. There's some kind of scandal going on that's being investigated. It is possible, Jim, I don't know this, but it's possible that as that scandal is unwinding, it's resulting in some banks that had positions they thought were hedged by physical metal, not really hedged, having to buy in order to make up for metal they thought they had that they ended up losing as a result of some kind of scandal or fraud situation. That's been speculated in some of what I've read this week on the internet about what might be driving the base metals, but I can't attest to that. It certainly is suspicious, though, that we're seeing so much strength across the metals and so much weakness across the soft commodities.
Well, one of the things that we've seen in the inflation index, the big movers of the CPI are owner's equivalent rent, which is moving up, energy prices, which we've been talking about, are moving up, and also food prices. So it's amazing to see where this is going to go. We've got some softness in some of the ags. But then on the other hand, Eric, I'm looking at lean hog prices up 64%, and you look at steer prices up 15%. I went to buy a grass-fed filet the other day, and it was almost $30 a pound at Whole Foods. That was a big shock. Well, listen, my friend, as we close, anything else you're looking at or anything coming up on your radar screen that you're aware of that our listeners should pay attention to?
Boy, Jim, $30 a pound for grass-fed beef, and based on the size of some of the steaks I've seen you eat, that's about an $85 steak. We didn't cover interest rates. The thing that I am perplexed, I don't know if you guys have a view on this, but it looked to me last week like maybe we were really seeing a run back towards that 2.4% in yield. It looked like yields on treasuries were coming down. They just suddenly turned back to the upside in the last few days. And it looks like as we're speaking midday on Thursday, maybe they're starting to turn back up again, but they're kind of being whipsawed back and forth. So it seems like the interest rate market can't decide where it wants to go. I'm watching that closely because I'm very fascinated to see what comes out in inflation data in coming weeks. Are we seeing the beginning of an inflation trend that potentially could grow to a point that it goes beyond the Fed's control? Or are we just seeing noise, as Janet Yellen has seen? I don't think there's enough data yet to be conclusive, but that's what I'm watching most closely as we look forward.
All right, Eric, as we close, you want to give out your website, if you would.
Sure, you can find me at www.erictownsend.com. That spelling is ERIKTOWNSEND.com. While you're there, be sure to sign up for a free subscription to my Peak Oil Investor newsletter.
Worst thing you can possibly do is to operate in a new environment using the rules of the old environment. But surprisingly enough, that's what a lot of people seem to be doing nowadays. You've heard Jim and me discuss the old normal versus the new normal now, including inflation and oil, with oil being one of the big driving factors now in new business cycles. Some of the old rules aren't working. It's very clear we're in a different environment. But what are the rules of the new system, and how can we expect them to behave? This is very important as we go forward into the rest of the year. That's the major subject of conversation on The Big Picture today as the Financial Sense News Hour continues. Don't go away at financialsense.com.
We'll have a heck of a time.